All right, let's get started. So I am Randy Sadler with CIC Services. I'll be your host along with Bryan Ridgway. So our session is titled Grow Your Client Base, utilizing CIC Services Bundled Captive Insurance Program. You might be wondering, what is a bundled captive insurance program? It really is a middle market game changer, and it's going to be a fantastic way for many of you to grow your client base and also to better serve your existing clients. So we're very excited to share it with you. I do ask, keep your computer and your phone on mute unless you're asking a question, and we will pause and ask questions along the way. So that'll be a great chance for you to say something and ask your questions, and we'll be glad to answer them as we go. So let's talk a little bit about our objectives today. I mean, one of the things that's very exciting about the bundle program is it really gives your clients and some of your prospects as well a way to reduce their commercial insurance spending. In fact, they can reduce it by as much as 50%, which is some massive savings. It also gives them an opportunity to gain more control over their risk management program. That includes things like how claims are administered, for example, which can be a big deal. Another great benefit is really creating an additional profit center, which we'll speak to, and then also building a pool of investable assets or assets under management. So all of those can be huge benefits for your clients and for the businesses that you serve, but also these can help you attract new business as well by using the bundle program as a door opener. I'll tell you a little bit about CIC Services. We are a captive insurance company manager. We help businesses set up and own their own insurance companies, take control of their risk management, and better position their companies for long-term success and survival. So that's really who we are, and we'll be glad to send you these slides if you want them, so you don't have to feverishly scratch down notes as we go. Be glad to send them to you. Just send me or Bryan an email after the webinar. Okay, next slide. Let's see here. Okay, let me do a quick, there we go, that's why. Quick intro. So we're going to be spending a lot of our time today with Bryan Ridgway. Many of you may know Bryan. Bryan is our Chief Operating Officer, Managing Partner, principal in our firm. He has his ACI designation, so he's an associate in captive insurance, and he's been working in the captive space for 2 decades. Really has an accounting degree, and then started out being an offshore captive manager, if you will, and before he joined CIC Services. So we're thrilled to have him on our team, and he's very talented and leads our entire team here in Knoxville, Tennessee. And then I'm also your host. I'm Randy Sadler. I'm really our Chief Marketing Officer. I'm also a Managing Partner. And sorry, I'm letting new people in, so I apologize for the delay. Hang on one second here. I got a few more joining. All right, very good. My background, I grew up in Knoxville, Tennessee as well, so this is home for me. And really, I went to West Point, was a tank commander, and I always tell everybody I really learned my risk management in the Army, where I oversaw tanks, trucks, tracked and wheeled vehicles, and was responsible for the safety of as many as 300 soldiers at one time. And so that was really where I cut my teeth on risk management. I've been with CIC Services 8 years. And we have continued to innovate and bring exciting new captive solutions to the market. So it's been a great place to work. All right, so today we're going to dive in and we're going to talk about CIC Services Bundled Captive Program, and it really is the solution to traditional insurance. So at this point, I'm going to hand it off to Bryan and let him tell you about the bundle program and really how it is a game changer in the middle market. Bryan?
Yeah, thanks, Randy, and great to talk with everyone today. So as Randy mentioned, a lot of our clients, a lot of businesses we work with recognize that their commercial insurance program is really a sunk cost. They're paying premiums out, and very, very rarely are they getting much back in return for the premiums that they pay. And that has to do with for a couple of reasons, but primarily because traditional insurance carriers exist for the benefit of the carriers themselves and not for the businesses that they serve. They're trying to make a profit, so they're motivated to try and look after their bottom line. And as such, most businesses see increases year over year, despite maybe not having any kind of claims activity. And they also, carriers have a lot of control over the claims process. They want to make sure that they're settling things when they want to, and they don't get a lot of input from clients or from their insured businesses when claims are being reported.
Followed by pound. Otherwise,
and so the result is that people who are good risks, businesses that are good risks,
participants in the meeting. This meeting is being
are
You are muted. You have been put on hold by the host. You cannot listen or talk until the host releases the hold.
Sorry about that, Brian. I guess in the process of letting somebody in, it's okay. If it could remind everybody, please mute your computer and your phone. That would be great. Thank you. Okay, go ahead, Brian.
So yeah, the result is that businesses who understand how the commercial market works and understand what options are available to them are leaving the traditional market. And they're leaving the market through captive insurance companies, through high deductible plans, a lot of different options that are available to them. But what ends up happening is that there are fewer and fewer good risks, businesses that are running well with low claims and high premiums that are subsidizing all the bad risk. And so that creates kind of an endless cycle. If you're a good business and you don't have a lot of claims, you see your premiums go up every year, and you're continuing to subsidize those poor risks, the people that have high claims. So the cycle just continues on. And on the next slide, we kind of just show you what that looks like from a business owner's perspective. And that is paying premiums to an insurance carrier in exchange for that carrier assuming some risk. They take in premiums, they issue policies and pay claims if you have any. And at the end of the day, whatever money's left over from your premiums become profit to the insurance carriers. So it works for them very well most of the time, and not so great for businesses who are funding those premiums every year and generally not getting much back in return. So a solution to this cycle of commercial insurance and traditional insurance programs is the bundled program, as Randy mentioned. The CIC Services bundled program that we've put together allows businesses to retain up to 50% of their insurance premiums that they're spending on policies currently, which effectively allows them to reduce and or eliminate altogether the annual rate increases that they've been experiencing. And the bundled program allows businesses to have control over the claims process and establish protocols and work with claims defense counsel that they choose to have much more control over the outcomes in their claims that are being filed. So at the end of the day, those businesses that are jumping into the bundled program are able to get off that insurance roller coaster, if you will, the highs and lows of being insured fully through the commercial market. They're able to create a whole new profit center because they're retaining up to 50% of their premiums. Those premiums stay within their family of businesses and become a whole new profit center for them and give them a whole lot more control long-term over the destiny of their business. So those are the benefits that come along with being a part of the CIC Services bundled program. So Randy, if you'll flip to the next slide. What that looks like from a bundled perspective is very similar to what businesses are doing right now. You're still going to pay your premiums to a carrier. That carrier is going to issue policies. The carrier is going to assume risk in exchange for those policies. But through the bundled program, the carrier has agreed to share up to 50% of those premiums with the business's captive insurance company that we will set up and run for them. So there'll be a captive insurance company that's assuming some of the risk. And then whatever premiums are remaining in that captive insurance company at the end of the day that aren't used to pay claims, that aren't used to pay expenses, remain as profit to the business owner. So the captive retains 100% of that underwriting profit. So now you've gone from a situation where a business was paying 100% of its cost for commercial insurance, and that was a sunk cost. They were never getting any of those dollars back, to the opportunity where they could actually retain up to 50% of those premiums through this program. and through a captive insurance company that we would set up and run for them. So there are some significant kind of components to this. So I like to kind of lead off by talking about, if you would, Randy, on the next slide, what the program is and what it isn't. So the bundled program, as I mentioned, utilizes a captive insurance company, but it also provides coverage that's issued by an A+ rated carrier. So you are still getting the benefit of having an A-rated carrier for any property coverage that a business may need, or if there's any contractual obligations where they have to keep rated coverage. The bundled program provides that. The bundled program provides for flexible policy forms. So the design, the outset here is to replicate the existing coverage that the business already has in place. So we want to match those existing coverages, the policy forms, any endorsements or exclusions are all going to be matched. And it provides a long-term solution to their insurance challenge. So by forming a captive insurance company, taking a part of their risk, businesses are set up for a long-term solution to the challenges they've been experiencing in the captive market, in the traditional insurance market. What the bundled program is not, as many folks are aware, the bundled program is not a group captive. So a group captive is a different solution altogether. Typically, people in group captives have fractional ownership and not very much control. In a bundled captive, the business owner will have 100% control and 100% ownership of their captive. These bundled captives are going to be onshore, so there's no offshore reporting requirements or requirements to travel internationally for board meetings. And the bundled solution is not a short-term solution. It's not something that businesses should get into for 1 year because they had a bad claims year and they're looking for something to help ease the pain of a high increase on their premium renewals. This has got to be a long-term solution for businesses that are well run and for businesses that have good risk management programs in place. So you'll flip over to the next slide, Randy. There are a few components involved in the bundled program that I just wanted to highlight for you and talk a little bit about how it works. Not too dissimilar from what businesses are doing right now. A business would need to have a broker involved, and that broker is going to work through what's called a managing general underwriter, a company called International Re Limited, who we've partnered with on this program. And International Re will underwrite each business individually and determine the policy limits, help set the premiums, and issue the policies and everything on behalf of Liberty Specialty Markets, which is a Liberty Mutual company, and we'll talk about that in a second. So International Re is our underwriter. As I mentioned, in order to participate in the bundled program, the business needs to establish a captive insurance company, and that's the role that we play here at CIC Services. So we provide turnkey captive solutions to the businesses that are a part of the bundled program. And CIC Services brings our multiple decades of experience to the table when doing that to make things very easy and straightforward for clients that are looking to get into the program. And lastly, as I alluded to over on the next slide, there's a carrier partner that we have involved who's issuing the policies, and that carrier is actually a Lloyd's syndicate wholly owned by Liberty Mutual, who everyone knows here in the U.S. Liberty Specialty Markets is their subsidiary over in London, who's issuing these policies on an excess and surplus lines basis. But we get the benefit of Liberty's strong name and strong ratings. As you can see, they're A+ from S&P, A+ from AM Best, and A- from Fitch. So they have very strong ratings, which allows businesses to continue to meet all their obligations. So those are the partners that we have involved in this program that become kind of a key to making all of this work. But there are some other pieces that are important to understand too when we talk about the bundled program, and that is specifically kind of the lines of coverage that we're talking about. So over on the next slide, we've got listed out for you some traditional lines of coverage that are being underwritten through our bundled program. And some examples of that might be commercial property, general liability, pollution, professional liability, builder's risk, commercial and inland marine, a number of policies. In fact, the underwriters have about 18 different lines of cover that they've identified for this program, which could be included in the bundled program. You'll see there a little footnote down at the bottom. There are actually two lines that the program does not currently write are workers' compensation and auto liability. Those are lines that currently are not eligible for our bundled program, but we hope to be able to include those in the future. So for now, we could not include those. Sometime in the near future, hopefully we can, but there's quite a good opportunity here for a number of other lines, including property, which oftentimes is not an option for businesses hoping to share risk through a captive. So the program, as I mentioned earlier, does provide a lot of flexibility. The businesses can select which lines they want to include in their captive through the bundled program and which ones they want to leave in the traditional market. So if you're not comfortable taking risk on your, let's just say your professional liability line, if you're an attorney or maybe a doctor and you don't want to put your medical malpractice into the captive, but you still have big property and general liability exposure, you could write the other lines through the bundled program and leave your medical malpractice in the commercial market. So it gives a lot of flexibility. And there's an opportunity to utilize the international re-underwriters to replace all lines of coverage, which will allow brokers to have kind of a single market that they have to manage every year. So even though we may not put that medical malpractice as an example into the bundled program, the brokers can still write that through International Re as the MGU and still have that all kind of handled through one market. So that's kind of a quick background on kind of how the program works and some of the coverages that are written. I think, Randy, I'm going to kick it back over to you.
Yeah, Bryan, we've got a chat question, Bryan. I'll let you answer. I'm curious, why not work comp and auto liability? So why don't we tackle that first? And by the way,
sure.
if anybody has a question, you can definitely type it in the chat bar and I'll read it and we can answer it. And we'll open up for questions at the end, just so you know, and we should be through with most of the slides by 2:30, so we'll have plenty of time for questions. Go ahead, Bryan.
Yeah, great question. So the question was, why does the program exclude workers' comp and auto liability? And the answer right now is because our carrier partner that we're working with, Liberty Specialty Markets, which is a syndicate out of Lloyd's in London, is issuing policies for this program on the excess and surplus lines basis, and they've not made that program open yet to workers' comp and auto liability. Part of that is due to complexity with filings on their side. Another part of it has to do with collateralization and working with individual captives that don't have large balance sheets out of the gate. And so Liberty being comfortable with reinsuring some of that risk that has a higher frequency or tends to have a higher frequency of claims. So they would, if they were going to work with a captive and reinsure some of that risk, we would have collateral issues where businesses would have to kind of stack collateral year over year. So they're working through some solutions for that, and we hope to have that in place pretty soon. But right now, like I said, the workers' comp and auto liabilities are not an option for the program.
Very good. Good answer. All right, but let me take over here for a little bit. So we want to think about, hey, I want to obtain coverage. I want to be in the bundle program, or I've got a prospect that wants to be in it, or a client that would benefit from being in the bundle program. What are the steps to make it happen? Well, there's really just a three-part process. The first is really to get underwritten and obtain a quote. So we get a quote from Liberty via IRE, a bindable quote that the carrier is willing to insure the business for all the policies that they're willing to take over, and then reinsure part of that back to the captive. So that's awesome. Once the client accepts that quote, we form a captive insurance company, which is really that separate or second profit center that I alluded to, where the business or business owner owns their own insurance company, and that insurance company is reinsuring Liberty. And if there are no or low losses, then the money in that captive piles up as underwriting profit, which is creating that separate profit center that I was talking about. If you're an asset manager, that creates assets to manage locked inside that insurance company. So very powerful there as well. Then really step 3 is to retain those premiums and profit, right? The premiums that Liberty pays back to the captive really belong to the business owner or whoever owns the captive. And then the profit accumulates over time, especially with good risk management practices in place. So underwriting, really you can use your existing broker or very often clients can choose a new broker. And so this is why the bundle program can be a very powerful door opener to get into maybe a really good client that you haven't been able to break into. You introduce them to the bundle program, they have a chance to retain half their premiums back, and they're very excited about it. This may particularly be the case when a business owner or business has had 3, 4, 5, 6 years with no or low losses, and then they keep getting rate increases and they're starting to get a little frustrated. They're ideal candidates for the program. And you know, we are definitely in a hard market. Insurance costs are rising, so this program may be particularly attractive now. IRE underwrites your business based on your experience, not the market, and that's one of the beauties of this program. Typically, we all experience rate increases based on the market, even if our business is having low or no claims or losses. And then IRE provides a quote, and the business owner or business or risk manager, CFO, is able to decide how much they want to reinsure to the captive. So you don't necessarily have to reinsure all 50%. Maybe in the first year, you only want to reinsure 10% or 20%, take less risk until the captive grows strength and the business or business owner becomes comfortable with the program. So that's the underwriting step. Step 2 is forming a captive insurance company, and that's a large part of the role that we play. CIC Services provides turnkey captive management. That includes all the steps of forming your own insurance company and getting a license for it to write insurance, and the corporate formation and all the things that go with that, actuary work, and running the insurance company. As it notes down here at the bottom, Liberty gets the premium and risk. They retain part of it, and then the captive obviously retains or takes on a layer of risk for the premiums that Liberty pays to the captive. So the captive is able to basically reinsure Liberty. And then you're really protected. If you look at C at the bottom, you're protected from high frequency, high severity losses because you pass the really big losses on to Liberty. But the smaller losses the captive can absorb. If you manage those smaller losses, the business is really just able to take all that to the bottom line, if you will, in underwriting profit in the captive. So step 3 is retain those profits. So the captive keeps up to 50% of the premiums and corresponding profits. One of the powerful things about our program is that the business owner is able to choose their own investment manager and manage investments according to the investment policy statement, or IPS, that will be in place. So as profits grow, the business has the ability to potentially take on more and more risk. That captive, obviously, as it builds up assets, is a stronger and stronger risk management tool, opening the door for it to take on more and more risk. I think I saw a question in the chat bar. Let's go there. All right. Is there a shared risk pool? Great question. And I'll let Bryan talk about the pool.
Yeah, Randy, thanks. If you flip back to the prior slide, it kind of touches on that briefly. Mm-hmm. And to answer the question, Tom, it's a great question. The captives that are assuming risk from Liberty through the bundled program likely are going to need to have risk distribution. And that risk distribution is kind of one of the key components to all of insurance companies. And most captives that we manage are getting that risk distribution through participation in what's called a risk pool, which is essentially a mechanism where each captive is reinsuring another captive or the other captives in the program. CIC Services has set up a independent risk pool exclusively just for this program. We call that Knox Re, or Knox Reinsurance Company. And Knox Re is our pooling mechanism. Inside of that pool, we're sharing claims that the captive would be responsible for, and those claims are shared on a 70-30 basis. We can get into some more details, I think, maybe on another call, but that 70-30 sharing is designed to allow the majority of claims from a particular business to pass through to their captive. So 70% of a claim from one particular business is going to be paid by their related captive, and 30% of that claim is then going to be shared by the other captives in the pool. So we're on a 70-30 sharing ratio for the risk pool program here. So that's a great question, and I appreciate, Tom, you asking that. We'll jump ahead here, I think.
I think it's your turn, Bryan. So slide 20 is Bryan.
Perfect.
Ridgway.
Yeah, great. So thinking about, whether a business is a good fit or not for this program, we've kind of alluded to some things that might exclude a business from doing the bundled program through our conversation today. But some things to think about as you're thinking about clients or prospects that you might want to work with and introduce this concept through. Big picture, we want to work with businesses. We're trying to be very selective on the front end of this program to limit this to businesses that are good at managing risk and not just lucky. And what I mean by that is they have good safety manuals, handbooks, loss control procedures in place. And as a result of their efforts, they're seeing low claims activity. They don't have a lot of losses. So we want to look for businesses that are really good at managing their risk. And those folks in those businesses, we want to work with folks that have a desire to have more control over their claims process. This is one of the great benefits to getting involved in the bundled program with using a captive, is we get to have a lot of input in those claims or the claims process. Businesses also want to participate in their risk, right? The bundled program only works because a part of every premium dollar that goes out the door is coming back to their captive, and their captive is taking on risks. So they have to be comfortable taking risk on themselves. And if they're doing steps 1 and 2 up above, they should be very comfortable with taking risk. They do need to have, we look at a kind of a minimum premium spend as a threshold to kind of start a brand new captive for this program. And so if they're spending anywhere from $250,000 on up on premiums for coverages that are eligible for the program, so not counting your work comp or your auto, anything like that, but all the other eligible lines, premiums are $250,000 or more, and this is something they would be eligible for. And they've got to have good loss history. Every business, whether they have great loss controls or not, will have that 1 in 5 year event. 2 in every 10 years, they're going to have some event. Those businesses aren't excluded from this program, but if they're having large events every year or multiple times a year and it's leading to large loss ratios, then they're probably not a good fit for this program either. And that leads into the next slide, which is a discussion on who's not a fit. And so when we think about who's not a fit, there are some industries that the program won't touch. Those industries traditionally are a little bit harder for carriers to underwrite, for carriers to get comfortable with, and our bundled program is not an exception to that. So auto manufacturers or businesses that make safety critical auto parts can't participate in this program. Cannabis trade, not surprisingly, is not allowed in this program. So anybody that is directly related to the cannabis industry, or even maybe on the peripheral of the cannabis industry, may not be eligible for this. Oil and gas production, firearms manufacturers, pharmaceuticals, there's a host of them here. And then we put in here that there are other industries and classes that could be determined based on their individual characteristics to not be eligible either. So we always encourage folks, unless you're working with a business who's specifically in one of these industries, if you're not sure, just go ahead and send a note over to myself or Randy or anybody else here on the team, and we can help you determine quickly if that business would be excluded for any reason. Other characteristics that might preclude somebody from participating in the program is kind of the opposite of what we just talked about. They don't really have a strong risk management program. They might have good claims history, but it's only because they've been lucky and not because they've been good. So that would probably preclude a business inability to participate or desire to control their losses. They don't have that ability or desire. High loss ratios and businesses that aren't interested in participating in their risk. Those are all kind of the opposites of some of the things we just talked about on the last slide. So those are some characteristics to look for. I think I saw another question pop up. I don't know if we want to stop now, Randy, or
let's
at the end.
Go ahead and answer it. We've got a question that says, walk us through the process of adjudicating a $1 million general liability claim. This says assume it's a 50-50 structure. Actually, it's not. It's a 30-70. So let's just use the 30-70 since it's not 50-50. Who pays what and how? Sure.
So a great question. For this program, we have contracted with Gallagher Bassett, large claims handling firm. Folks in the insurance industry will know who they are. Gallagher Bassett is the TPA that's going to be reviewing all claims on this program, but each individual insured business is also entitled to have their own claims defense counsel if they want, and there's a laundry list of pre-approved attorneys that can provide those claims defense services, or we can get other attorneys approved if we'd like. So once we've cleared those hurdles, we've had the claim adjudicated, the claim has been approved, and assuming there's $1 million GL claim or general liability claim to be paid, that $1 million would be broken down first between the carrier that wrote the policy, Liberty, and the captive. So we haven't talked in a lot of detail on this, but when Liberty is reinsuring risk back to the captive, that risk to the captive is related to the captive assuming a certain amount of risk per occurrence or per claim, and a total amount of risk in the aggregate. And typically the cap on that, so the most amount of risk is set at about $250,000 per claim per occurrence and $1 million in the aggregate. So if we have one claim that gets approved for $1 million, the captive would only have to pay $250,000 of that, and the carrier, Liberty in this case, would pay the next $750,000. So they'd pay the second part of that. So the captive is really only concerned about the $250,000 that it has to pay. And because we talked about that risk pool, the Knox Re component to this program, that $250,000 is actually then going to be split even further. So the first 30% of that, which my math is not good, but what is that? 75,000,
yeah.
75,000, there you go. So the first 75,000 would get shared by the captives in the pool, and the remaining 175 would get paid by the captive related to the business that filed the claim. So that 75,000 would be the 175,000 would be that business owner's share in their captive. And then the 75,000 would get paid by the other captives in the reinsurance pool in Knox Re, and that gets divvied up on a pro rata basis. So pro rata based on their share of total premiums in the program that year. So long-winded explanation, but there are a number of different layers in there.
Looks like we got another question. Let's go ahead and take it if we can. Let's see here.
Yeah, I saw that pop up. So the question is, if there's a client who already has a captive, can we include the bundled program? The answer there is probably not in their existing captive, unless CIC services can take over the management of that captive. So as you can imagine, getting folks like Liberty Mutual involved and their MGU international re-involved. CIC Services had to go through a pretty significant vetting process to be considered as a qualified manager on this program. So they wouldn't have to set up a new captive. If it was possible, we could take over their existing captive and then add this program to it. If for some reason we couldn't take over their existing captive, then yes, we could set up a new captive for them just to do just for this particular program.
Yeah, very good answer. And before we move to the next slide, I think I'll offer one bit of clarification on your example on the $1 million claim. You know, with Liberty stepping in from 250 to $1 million, obviously if the captive took less risk, the point where Liberty steps in might be lower. So they might come in at 150 or 100 if the captive takes less risk. So that attach point where Liberty steps in can move, just so you know. It's not always 250. All right, very good. Well, let's move to the next slide. We've got some case studies Bryan's going to walk through. I think we have 3 of them, so this will give you an idea of what kind of client might be a fit for the program.
Yeah, so the first one we've got here is a general contractor who does renovation and demolition work in New York City. A very difficult class of business to write, just generally speaking, without throwing in the fact that they do work in New York City, which is a very difficult market as well. So they came to us. They had a great history on their losses related to their general liability policy. They were seeing massive rate increases every year. And so they came to us and they needed a primary line, a primary policy that provided them up to $10 million of cover for some of the work that they were doing. And so we were able to go through the underwriting process, get them underwritten and approved, and a policy issued that provided them up to that $10 million limit that they needed for their GL line. And Liberty came back and said, as part of this program, they will allow the business to retain the first year. I think it was 33% of their premium. So their premium came in at about $800,000 on that particular policy for their GL, and they were able to retain back about a third of that. Their first year actually just wrapped up a little while ago. They had no claims. So after their expenses on that, it was about $270,000, I think they took back into their captive from a premium perspective. They're going to have profit of just about $250,000 their first year. So on $800,000 of premium, they saved, well over 20% their first year, which was a great win for them. What was even better win for them, back to one of my earlier points, is that we just got through their first year renewal in the program. And despite everything happening in the world today, with insurance markets hardening and things getting even more difficult to place coverage, especially in New York City, they got a flat renewal back from Liberty. So their premiums did not go up. And in fact, in addition to a flat renewal, Liberty actually agreed to reinsure more risk back to their captive. So their second year, they're going to be taking, I think, 45% of their premium back into their captive, or almost $400,000. So they're a great success story, and they've seen a lot of benefit from the program in their first couple of years in participation. Our next example to walk you through is an auto dealership that we worked with out of Florida, actually South Florida, who, again, they've been very good at managing risk over the years. They were proactive. In South Florida, there's opportunities for hurricanes to come through, obviously. And if you're an auto dealer and you've got millions of dollars of cars sitting in your lots, you got a lot of exposure sitting on your lots. They had safety programs and risk management programs that required that if a named storm was forecast to make landfall in Florida, they actually shipped all of their vehicles out of the state. They put them on trailers and drove them out of the state. So the risk that they had of suffering a loss on their inventory was basically zero. And as a result, as you can imagine, they had very good loss history. So they were looking for a solution to their property coverage for their inventory, as well as some of their dealership locations. Their first year of participation in the program, they were able to get underwritten and retain 40% of their first year premium. So they were paying quite a bit. I think their premiums were $500,000 or thereabouts on their property coverage, and they were able to take 40% of that back into their captive the first year. So very, very beneficial to them as well. And their forecast, as you can see over on the right-hand side, their forecast, their year is up here in about a month. They've not had any claims yet, so they should have right around $200,000 of profit in their captive this first year. Another great example for you guys. And a third one is a textile recycler. So these folks came to us through their broker. They were seeing large increases. Primarily, they felt that the market didn't really understand their risk. They were looking for a number of different lines, but specifically property coverage, general liability and excess as well, but property was kind of their big pain point. And their broker really hadn't been able to find many solutions for them in the commercial market on the property side, and until they came across the bundle program, and we introduced them to this concept. And on the bundle program, we were able to allow them to participate in the first layer of their property coverage while leaving the rest of that exposure with Liberty, and allow them to take premium, just like in the other cases, back into their captive. In their first year, they're going to retain 40% of their premiums that they were paying to the commercial market. All the policies remain the same, coverage remain the same, but their captive now is taking in premium, and they're expected to earn about $200,000 of profit in their captive the first year as well. So very, very beneficial programs. One of the things all of these businesses had in common was, if you guys heard, is their risk control programs. They had low losses. They had very, very good programs in place to mitigate and manage losses. And as a result, they're now getting rewarded by being able to participate in those profits that were previously being paid out to the commercial carriers.
Very good.
Randy,
very good.
Kick it back over to you.
Yeah. So let's just talk a couple more slides, guys, then we'll open up for more questions. And of course, you can always chat them as well. But let's just talk kind of a summary of what we've covered today and timeline if you wanted to introduce a client or prospect to the bundle program. So the huge things are the bundle program lets your clients keep up to 50% of their insurance premiums. Often reduce or eliminate rate increases like Bryan was speaking to. You also have some control over your claims, right? So very often I talk to a business owner that is furious that their carrier settled when they wanted to fight, or fought when they wanted to settle. And who's the big loser usually is a business owner, because they kind of know their market. They know if they will win or not. They know the local courts better, and their local lawyers often know better. And a bad decision by the carrier ends up costing a lot of money. And then what happens? They get stuck with a huge rate increase. So having some control over claims is huge. And remember, this allows the client to choose their broker, right? And so that's why this is a great way to come into a client that you're trying to get into, or you may have clients with that are good, not lucky, as Bryan spoke to. That if you put them in this program, then the chances of them ever leaving you would be very small, right? Keep the risk you want, transfer the rest of it to Liberty, and then benefit from Liberty's A+ rating, which is very powerful as well. We've got 4 questions in the chat bar, which we'll get to here in a second, all right? So remember, kind of what I talked about earlier, reduce commercial insurance spend for your clients, more control over the risk management program, additional profit center, and investable assets in the captive if you do manage assets. And we've got really what I'm showing here is a kind of a 30 to 60 day timeline. So we can really stand this program up within 1 to 2 months, which is quite powerful as well. So we have a very simple questionnaire, and that questionnaire allows us to obtain pre-approval. And then we can go and put together a model and share it with your client or prospect, and then go and obtain a bindable quote from Liberty that the client can actually purchase the insurance coverage with the guarantee that a certain percent will be reinsured back to their captive. Review the quote and select the premium level they want. How much risk are they willing to take? Engage us to be your captive manager, engage a captive attorney to form the captive, pay premiums to Liberty, which in turn premiums come back to the captive, and then invest that captive surplus and grow it, keep 100% of the profit. So couldn't be any easier than that. We'll take the questions in the chat bar kind of one by one here. So let's open this up because this is our time for questions. And let's start at well, let's see here, moved quite a bit. All right. What do we need?
Randy, I think you answered.
Yep. What do we need?
We got that first question answered there with
yep.
that summary timeline there. So Tom, we can send out to you all our questionnaire. That's very basic, just gets us some general information on the business. That information will give us enough to go out to the underwriters, IRE, and get a pre-approval. So we don't want to waste anybody's time if this is not going to work for various reasons, whether they're a restricted class or they've got bad losses or whatever it might be. We can weed those out pretty quickly. We'll get a pre-approval from IRE, and then assuming that that IRE gives us that pre-approval, then we would need just the standard information that businesses normally provide or brokers normally provide when they're getting quotes on insurance. So loss runs, copies of the expiring policies, and some other related information for International Re to generate the quote for coverage from Liberty.
Perfect. And the next question was, you mentioned excess in one example. How does that work? They just buy, say, the first few million and still buy another traditional excess layer over that?
Yeah, so it's a good question. So this program through Liberty and International Re only allows the captive to participate in risk on the primary lines. So the primary lines of coverage, those first dollar coverages that are being purchased by the business through Liberty in this program, can be reinsured back to the captive. If the business has a need for risk or for coverage higher than what those primary lines are able to write, and they need to buy excess, they can still do that through this program, but they won't be able to reinsure any of that back to their captive. And the reason for that is typically just because the premiums being spent on excess coverage don't typically amount to as much as the primary lines. There's not as much premium to be shared, and the carriers typically won't reinsure any of that risk in a standard program. So yeah, only the primary lines are available for participation through the captive, but businesses still can get access through this program if they need it.
And then we've got a question, has the program been audited by the IRS?
So short answer is no. This is a relatively new program. So International Re actually developed this program and took it to market the beginning of 2019. CIC Services was the first manager to partner up with them and develop a structure for the distribution of risk through our Knox Re program. And we've been one of the primary partners they've had since the get-go. But because it's so new, no, we haven't had any experience with in dealing with the IRS or any of our clients that we know of yet. And I'll knock on wood, but I don't expect that anytime soon, just because this is such a new program. The second part of that question would we represent clients if they do get audited? And the answer to that is not directly. No, CIC Services is not an attorney firm, not a law firm. We're not CPAs or tax professionals. We will work with the client if they do get audited, which hopefully they don't, but if they do, we will work with the client to help provide information that the IRS is requesting and assist with all the document production. But if the client decides that they need guidance, and they probably would want guidance from a CPA or an attorney, they would have to contract with those providers on their own.
Do you have to be a P&C agent to work with the program?
Not directly, no. So the program does require a P&C agent to place the coverage. We talked a lot during the presentation today about keeping a broker or replacing a broker. We do need a broker for the coverage to be bound. So there has to be a broker involved, but we've worked with a number of folks who are not brokers who have clients that would be a good fit for this program. And those individuals may be investment managers, wealth advisors, connected to the client in some other way. And so they don't necessarily have to be the broker that's placing the coverage to still participate, because at the end of the day, if the business is paying premiums and those premiums are coming back into a captive, somebody's going to need to manage those investments, and that's also not what CIC Services does. So they can be involved in the program overall, but just not in the placement of coverage if they're not a broker.
Yeah, good answer. Next question is there a feasibility fee for the preliminary work done by CIC Services?
That's another great question too, and something we've gone back and forth on since we started this program, but the answer is no. So if you're looking at that timeline that Randy had up on the screen a minute ago, everything up and through the second step of that process, so after you've got a pre-approval and the custom model, after we've got that bindable quote, there's no cost for any of those steps until the client decides they want to actually form the captive and bind the coverage. At that point in time, we do charge for our work, as well as the attorneys who are going to be doing the legal work to form the insurance company. So that's when they would start incurring fees. But up until that point, there are no fees involved in this program for getting a quote.
Very good. And then once in the program a few years, how does a business owner or a broker keep Liberty honest with the carrier quotes if there is no alternative market for a competing rate?
Yeah, nothing stops a broker from going out and getting quotes from the market to make sure that the quotes that we're getting back from Liberty are they're comparable to the rest of the market. There's nothing stopping a broker from doing that. And in fact, on some of the renewals we're working through right now, the brokers are doing that. They just want to see what the market will bear. So that's one way to keep them honest, if you will. But bigger picture, remember, because the client is benefiting from retaining premium and keeping profit in their captive, even if they are seeing some rate increases, as long as those rate increases are bearable and not just somewhat drastic, that rate increase only really means there's more money coming back into their captive if they're managing their risk well, and more profit for the owner. So not that Liberty would ever artificially increase premiums, but that is another way to think about it.
Very good point. Yeah, and certainly, Brian, they could, if they got a really good rate somewhere else, they could jump carriers and let the captive run out, right? And just take the money and run. So
they could.
It's their money and their captive, right? The next question we have, what are the setup costs and management fees to run the captive? And then I assume the captive is making the 831B election.
Yeah, so I'll tackle the fee question first. So on the front end, for the formation of that insurance company, once they've got that bindable quote and they're ready to bind coverage, there's a one-time formation fee of $50,000. That covers our fees, covers the actuaries, the underwriters, and the attorneys. So that's an all-in fee. And then once the captive is operating, the fees related to operations, which include our services, CPAs that are going to be doing the financial statement audits and tax returns, the actuaries and underwriters, the attorneys that are staying on board. Those fees cumulatively total up to $45,000 a year, or it can scale up some, and so it's set at 5% of premiums. So 5% of premiums or 45,000, whichever is more on the ongoing cost. And the reason for the scaling there is just because it can, as premiums increase, it can increase the complexity and level of work involved in the program. The question on the 831B election, so the question was, will the captives be making the 831B election? That's not a requirement. That's a decision that each individual business owner and captive owner can make. Our models, when we model these out, they assume that they are making the 831B election, because in most cases, the premiums coming into the captive are going to be under the threshold. And so if the premiums are under the threshold and the program is eligible for that 831B election, then we've modeled it that way, but that's a decision that each business can make on their own, each captive on its own. It's not a mandatory requirement for them to participate.
Yeah, very good point. I had somebody ask me, do I have to take an 831B election? You certainly don't have to. And if the 831B election scares you, then don't use it. Just do 831A. You're still getting all those commercial premiums back, right? So you're still creating a profit center. Good. And we have another question. Can you send the PowerPoint to us following? Yes, of course. At the beginning, we laid out, we'll be glad to send you the slides. Either email Bryan or me. You've got our emails right here on the screen. Shoot us a note, and we will be glad to get the slides to you. What is the additional expense to add a traditional captive to be included?
So I'm not sure I followed the question. Maybe, Tom, it might be helpful if you and I, or maybe we all can connect afterwards and I can kind of talk you through it, because it's going to depend. If you're asking kind of if there's already an existing captive, what would be involved in adding this? I think that's what you're asking anyway. Then let's talk through that, because it's going to depend on a number of different factors. And so maybe we can address that offline and make sure I understand what you're after.
Very good. Yes, Bryan and I would be glad to field any questions that you all have. We're coming right up on 3 o'clock, so that we've gone the full hour. Really appreciate everybody's attendance today. Please reach out to us if you'd like the slides. Reach out to us with questions. We'll be happy to schedule one-on-one calls to go through the program with you as well and to partner with you. So with that, we'll conclude. Everybody have a fantastic rest of your week.
Thanks, everybody.
All right.